Yeah, we're excited to be here. Me and my partner Aaron. So I'm Robert Savoie. I'm chair of the FinTech practice here at McGlinchey. I think we were one of the original law firm partners to AFC and very excited to be one and to be chatting with you today. I think we're just going to go around and do quick intros for the panelists. And Aaron, do you want to go next?
I can figure out how to unmute.
You don't have to. I mean, we can just guess who you are, but go ahead.
I I figure I just, my presence speaks for itself. Um, as Robert said, I'm partner here, McGlinchey Stafford. Same office as Robert. He's, a wall away from me right now. I've been a partner here for about 4 years doing primarily payments and lending work. I spent about 16 years in-house at fintechs and banks. So I've dealt with these issues internally, and now it's fun to deal with them not internally. So you want to go next? Whatever order.
I'll go
Chris,
next.
first person to see. There, you can go. Yeah.
I'm happy to. Keith Tran-Trong, I lead the U.S. regulatory team at Visa, and appreciate the invite from AFC, and I am going to be the offset to the Robert and Aaron comedy show.
The straight man.
All right, Gary, you want to go next?
Sure. Hi, all. I'm Gary Stein. I'm with Accenture on the payments leadership team. I've been in banking and payments for my career as a banker. I was a consultant for many years, as I am now. I had a midlife crisis and became a regulator for about 9 years and led payments policy for the CFPB. And then left there in 2020 to actually start up a fintech as the chief product and compliance officer for an alternative payments company. And then started an advisory firm in the BaaS space and payment space a few years ago and brought that practice here to Accenture. So can wear a few different hats on this, but looking forward to a great discussion.
Awesome. Chris, you want to go?
Sure, I'm Chris Rigoni. I'm head of partner banking and payments for Axiom Bank. I've been in partner banking for going on 10, 12 years now, so quite a while, since the early days of Simple Finance. And so looking to offer a perspective from a little bit different angle with the partner banking perspective on payments and the regulatory environment. So looking forward to the discussion.
Awesome. Well, thanks so much, everybody. I mean, I think what we had talked about with AFC was starting off with a little bit of framing. And, obviously everybody on the panel is very familiar with payments regulation and the landscape, but AFC has a broad range of members and some are not as in the weeds on payments. And so I think what Aaron and I are going to do is just a little bit of a brief overview to sort of frame some of the issues that then we'll run through in terms of how people approach payments regulation. So Aaron, do you want to kind of run through and just talk for a minute about how payments are regulated at the federal level, and then I can kind of run through sort of the state regulation.
Yeah. And this is, as Robert kind of said, this is designed as a fairly high level overview, but, payments in the US are a little bit scattered, right? Like a lot of consumer regulations, but where you're looking for it from comes from a bunch of different directions. On the federal side, the Electronic Fund Transfers Act implemented Reg E. Most people think of it as Reg E. That's the sort of primary area where consumer payments are focused. Reg E, a very general concept, talks about electronic fund transfers, what the rules are as it relates to recurring payments, what the rules are as far as getting consent from consumers. But, you know, it's not error resolution is what we're going to talk about a little bit later, right? That's where most of the Reg E questions come in. That's where most people kind of get a little caught up is what happens in the error resolution, what happens when a consumer is disputing an electronic fund transfer with their depository institution, or, and we'll talk about this with Chris a little bit, if there's a non-depository that's involved, what is the interplay between the depository and the non-depository when it comes to that error resolution. So, you have that framework there. And then, while not federal necessarily, where it gets really interesting is that you have all of these other overlays, right? So you have card network rules that you're thinking about if it's a branded card. So a Visa branded card or a MasterCard branded card, if it's an American Express and you're in a three-party, however it might work, you're also going to have certain card network rules that you are having to follow within that. So, whatever the Visa rules might be as it relates to a certain transaction and how that interplays with, for example, Regulation E. You also have NACHA, the clearinghouse rules, right? And so you have rules that are related to how those ACH type transactions are going to work and how you can dispute through the ACH network transactions, how the different banks play with each other, right? I mean, it's really ACH, the way I kind of think about it is the agreement between all of the parties in the payment flow and how they interact with each other. So the originating bank, the originator, the receiving bank, any payment processors or third-party service providers that are sitting in between, how they all interact and how the liability gets shifted between them, right? So a lot of NACHA is about how the entities are shifting liability. But they also have some consent requirements and that vary depending on whether one-time consent or multiple consent. So you sort of have this and then you're going to talk about state here in a second, Robert, right? So like you kind of have this patchwork of payment rules that you're thinking about. And we're not even talking about things like FedNow. They have their own set of requirements if you're enrolled in the FedNow system. But it's a patchwork and it can be a little bit interesting to try to put it all together when you have a question and you're running it through all of those different areas. They're relatively consistent with each other, right? They do a decent job of being consistent. I think what we're going to find and what we'll talk about a little bit later is just, is it possible to have that framework keep up with the innovation that we're seeing in the payment space and how quickly the payment space is moving, and sort of what that looks like in relation to Robert and I do a session every year that's called innovative products, old laws, right? And how you sort of fit these innovative products and and that's especially true in payments where you're just seeing this explosion in the way consumers want to interact and consumers want to pay, and the regulations sort of staying relatively far behind.
Yeah. And then, in the state context, I'll breeze through this so we can kind of start digging into it and talking about what's going on a little bit. But at a high level, when you're outside of traditional banking, or fintech programs that are done in partnership with depository institutions, there's also non-depository money transmitters. And so if you think about traditional old school pre-internet branch-based money movement like a Western Union or a MoneyGram, where you have physical storefronts that you can go in and do money movement to, online payments mechanisms. So you can go in, log on, download an app, and then transmit money to other folks. That's regulated on a multi-state basis, through money services business regulation, money transmitter licensing at the state level. And on that level, virtually every state, I think there were really only two states that historically didn't have a license requirement for, within the U.S. money transmission. And one of those, Massachusetts, just expanded their previously fairly limited regime on Forex, to be a more comprehensive money transmission law. And I think the only other state is, mix this up sometimes, it's an M state. I think it's Montana. There's the only state left without a money transmitter licensing and regulatory regime. And so you have all these other states that have their own licenses that integrate through a combined licensing system. But you have to be careful because, if you're not properly engaging depository institutions to be the custodians and be handling those funds transfers in their capacity as depository institutions, you can inadvertently subject yourself to a wide range of state regulations. And once you're within those regulatory regimes, you have licensing, you have disclosure, you have permissible investments, and you have a number of other substantive requirements that come along with that. And you have multi-state regulation, and you'll get a number of exams on a one-off state basis, and then also multi-state exams. And so that's a pretty involved regulatory regime that you've got to be careful of. And it's one of the reasons that folks are careful and that they want to go to sophisticated banking partners to help them do that, to handle that money movement and the responsibility of that, which is sort of part and parcel to getting a bank charter in terms of doing that. And so I think with that overview, I mean, Chris, maybe I'll kick it over to you to kind of start off some of the discussion and, give us your thoughts. I mean, you're at the bank, you deal with these regulatory requirements. How do you think about these things, and how do you frame them in terms of thinking through compliance risks?
Sure. Well, I think first I'll kind of start off by saying that it depends, and I know that's a consulting answer. Gary will appreciate that, but it really depends on the environment, the regulatory environment, and that shifted quite a bit year to year, and even shifts from administration to administration, right? So when you look at the situation right now, we're in a season of deregulation. In a lot of cases, when that happens at the federal level, you see states step up and start to take more action, either through litigation or another means to protect their specific citizens in their state and what they are working towards. And so you'll see some of ebb and flow there. And then when at the federal level, you see more involvement in regulation, more involvement in the different organizations trying to put tri-party guidance out and things like that. That then you see less participation from the states in a lot of cases. So as far as managing the risk from a compliance standpoint overall, I think data is probably the number one issue, and probably of number one importance to be able to manage all of these effectively. Data from the partners in partner banking, and being able to match that with the data that you have internally. Once you're able to do that and deliver it to all the ancillary systems that you typically use to do this sort of thing, then you look to create efficiencies, right? So is there any way we can limit false positives? Is there any way that we can automate a lot of what's going on? Because it's very time consuming, and that is also resource intensive, right? So having to hire more and more resources to produce more and more scale. The other thing I would mention is that for community banks, especially that get into the partner banking space, you're going from a community bank that has maybe 1 or 2 or 3 states that they're operating in, to working with fintech partners that operate in maybe all 50 or close to it. And so you're taking in a lot of additional, to Aaron's point, and to your point, additional regulation, additional guidance, additional bodies that you're having to take into account that you weren't having to previously. And so it creates a lot of complexity that you're going to have to manage and have experience internally to be able to manage.
That makes sense. And Key, I kind of want to kick it over to you because you have a little bit of a different perspective, given where you are in terms of thinking through, how do you view compliance and regulatory risk on a payments basis? Do you want to talk about that a little bit?
Yeah, I mean, it's not necessarily distinct from the way Chris thinks about this stuff because, at the end of the day, the network is going to rely on the partner banks to be very laser focused on running a robust compliance program for, all of their different partners. I mean, and then similarly, we're also kind of watching the the ebb and flow of regulatory and enforcement between the push and pull between the state and federal regulators. And I mean, now we're back to the other extreme of maybe the federal regulators are taking a step back in a question of what are states going to do? Are they going to, because obviously they're focused, as Chris said, on protecting their consumers. So do they feel like they're going to need to come in and be either the cop on the beat, or do they need to come in and fill the void and taking some of these sort of new creative, whatever you want to call it, regulatory interpretations to try to fill that perhaps perceived void. And obviously it's going to depend on the perspective of the particular regulator. But I mean, obviously we've seen certain states, New York, California, saying, look, I mean, if the feds are not going to be as active, we still have a job to do to make sure our consumers are protected. So we're certainly kind of watching that dynamic, because certainly if things go to states, it becomes harder to as a partner bank to operate on a state by state basis, as Chris said, right? You might be incorporated in one state, but your fintech partner is going to want to be able to operate everywhere. So it just makes it, exponentially harder to like stay on top of everything. And then just on compliance risk management, I touched on this a little bit, but it's, I mean, I think we're really focused on, to what extent the federal regulators will continue to be focused on compliance risk management by partner banks, because the BIN sponsorship uh, ecosystems is really important to us. Obviously, it's important to the people, the members of AFC, and I think it only works well if um, you know if the partner banks and the fintechs are managing compliance risk, managing AML, really know what kind of program they're running and what the potential risks are. And I think over the past couple of years, right, we saw the federal regulators taking a lot of enforcement actions, and I think well-run partner banks have always been sort of focused on the issue, but I think the increased focus on from the federal regulators has kind of opened the eyes of everyone kind of in this space, which I think is honestly healthy for the network ecosystem. So stop there.
No, I appreciate that. And right before I kick it over to Gary, just, really love what the two of you just said because it's so important, especially in the partner context, right? Like understanding whose responsibility and getting that out of the way early, right? Having that conversation up front as to what it looks like, because generally speaking, and there are some exceptions in Reg E to some extent if you're the issuer of the access device, right? You're a non-bank that's actually issuing an access device. But for the most part, regulatory obligations stay with banks, right? And so error resolution is a bank's responsibility, generally speaking, but there are often times where the non-depository is doing a lot of that work. But there are strict timeframes, right? Reg E has strict timeframes. NACHA has strict timeframes. And so getting that line of communication down that both of you were just talking about up front and that compliance framework up front to say, look, we need to do this within 10 days. We don't get vote generally, right? You can go out longer, but we got to do this quickly. And you need to understand how that's going to work, and we need to understand how we're going to talk to each other. That's often missed when everything else, right? All the business aspects of getting the bank partnership take precedence sometimes, and you kind of forget about the little operational things like communicating the documentation that Chris was talking about, right? Like how you get the information back and forth to each other so that you can properly manage the dispute. Last thing I'll say about that is just we know that there are, that the significant consent order that came out that did not, despite what a lot of people thought, did not say you can't use automated means to manage error resolution, but it did say that you have to actually investigate and you can't just sort of rely on the artificial intelligence or whatever it might be that's doing it. You have to actually look at it and work the case. That can only happen in that bank partner context if you're having really good communication with each other, right? And you're really able to have that documentation and do that proper investigation. So just want to say that's double down on what the both of you said, that we see that a lot in these bank partner programs. But Gary, I'm kicking over to you for your thoughts on this.
Oh, Gary, I think you're muted.
Okay, now I'll talk. I agree with all that's been said. At the same time, I think if you think back to the world before fintechs and everything was bank to bank, you kind of had an apples to apples ecosystem. Even in, a Visa network, you have merchant acquirers and issuers on either side that are banks that are, might have different regulators going under, different supervisory regimes, but essentially held to the same expectations. And as we've moved into fintech, and in no way saying that's a bad thing, we've moved to a much more heterogeneous business model. And as the BaaS space expands, you have banks like Chris's that do this as a business and probably very strong due diligence, oversight models, agreements with their partners on who performs what. In other cases, some of these banks may be moving into that space with different business intents in mind. Maybe it's to fill a capability void and not so much to run a fee-based business. And the oversight could be arm's length, but maybe isn't as institutionalized as you might see at a bank like Axiom, perhaps. And then on top of that, I can tell you from conversations I've had with some fintechs that, like two senior folks talking at two BNPL firms of roughly the same size. And one of them was relaying to me that they were talking about how many compliance folks they had at those firms. And one of them said 7 and the other had 165 or something of that. So we've got we don't really have a steady state out there. And then on top of that, what Key and Chris and everybody else, Robert, you and Aaron talked about is like, okay, we've got this void forming maybe in this era at the regulatory level, disparate state, and then meanwhile, as we're watching maybe the nuclear annihilation of the CFPB or something close to it, right? It's not even really deregulation, and last month they eliminated guidance and advisory opinions on 80 or so documents, and maybe a lot of folks here would celebrate a lot of that, and I'm not debating any of that either. But the expectations then for what constitutes compliance now are fuzzier for a lot of these things. And if you think about something as regimented as dispute resolution timeframes, in a credit push world, we've already seen some regulatory consternation about, what constitutes authorized in a credit push world, right? So there is this state, I think, of the who is in charge is changing, the capabilities of the players in the ecosystem are changing, and we're seeing emerging technologies where we haven't really gotten to a consensus opinion on what constitutes compliance or not. So it makes it a little challenging, I think, for players to navigate, and the type of communication between the fintechs and their banks is even more paramount.
Absolutely. And I've seen that there are a couple of questions. So I think what we'll do is we were going to transition a little bit to sort of talk about how folks handle risk management in that context, right? You have a significant changing environment. Then we'll kind of pause, go through the questions that are there. So if you have some and you want us to kind of address them, drop them in. And then we had some sort of discrete current issues that we were going to kind of bop back and forth after we do that. So that'll what we'll do for the next 15, 20 minutes or so. But in terms of risk management, I mean, Chris, let me kind of go back to you because you kicked us off here. I mean, you've talked about risk management. You'll have a number of programs. I mean, in context of a changing federal landscape, and he talked about some of the concerns about states and they're going to now enter in and it may be in areas where they haven't because of that need to handle consumer protection. Like Gary said, from the detonation of some of the federal regulators that maybe or pull back and they're not going to be there. I mean, how do you approach that? How do you think about risk management in terms of, operating an ongoing business with a lot of different things on your plate?
Yeah, I think you have to partner together as a leadership team and really understanding what your risk tolerances are, right? Where are the areas that you want to play? Where are the areas that you definitely don't want to play at the current moment? A lot of governance included in that. The technology pieces of it are the easiest part, right? Especially for partner banking. And I know that probably comes as a shock to some people, but the real hard part of it is the people, processes, and governance that are included, right? So, you can have data management under, wraps and ready to roll. You can have the architecture in a great state. You can have all of these components, a great suite of APIs. But if you don't have documentation evidence and you don't have, the people, process, and governance in place, all of that is not really going to work. And so at the end of the day, you have to have those components in place and have a really good understanding of what your risk tolerances are as a bank generally. And that leads into how you interact with your fintechs and what products you will and won't support. The other thing that I would say is that I think it's been sort of this fence system, chunk over the fence back and forth, and/or a waiting game for the regulators to provide some sort of guidance in a lot of cases. And I think I would like to see that relationship move towards more of a partnership. and be able to talk with regulators about roadmaps, talk with regulators about, the different things and different segments that, the bank is planning on entering into, or that we're thinking about. And luckily I've seen that work, and I've seen it work well, where the regulators are part of that conversation. They get education on exactly what we're planning on doing and how we're planning on doing it, and are able to provide feedback. It's the same kind of thing if you're developing a product internally at the bank, right? You don't want to bring risk, compliance, and legal in at the very end for them to say no 3 months before you plan to launch. You want to try to get them involved early in the conversations. And I think the same can be said for regulatory guidance, because this is a team sport, right? I mean, we're all trying to do the same things. We're all trying to make money in this environment, in the segments that we're participating in a regulatory safe and compliant manner. And so in order to do that, we're all going to have partnership and discussions about what are the outliers, where are, the pieces where here's the regulation, but it doesn't exactly call out this piece or that piece in detail. So how should we handle that? And if the bank is presenting a situation and presenting a way that we're thinking about handling it and gaining feedback from the regulators, and then making tweaks and adjustments as necessary, I think that's a way better model than, either doing it and then hoping that nothing bad happens, or, waiting on the regulators to provide some insight before you move, because the innovation freezes.
And Key, I'll kind of ask you, your approach has to be a little bit different in context of sort of where you are in your role. But, and I know you talked about sort of the partner banks having that first line of responsibility, but how do you think about that in your context?
Happy to address that, but I did want to piggyback on something that Chris just said, and I know it's something that Gary has thought a lot about when he was at the CFPB, but other folks kind of gave their history. I didn't, but before coming to Visa, I was at the Federal Reserve Board working on rule writing on credit and debit, and I think we always took the perspective that when we're writing rules, we can't write rules that make sense for the industry unless we and consumers, unless we actually have the conversations with the industry and the consumers to understand how different approaches might affect the market or for consumers. And you can take an over regulatory approach on things, but then you essentially make no products available for consumers and businesses. And so we were cognizant as well that you need to protect consumers, but you need to strike a balance so that the consumers do have a choice of products and services out there in the market. And as I said, like when Gary was running the market shop over at CFPB, he had tons of conversations with folks in the industry, including us or Visa when I moved over to Visa. But in terms of kind of risks management, I think I did address some of our perspective, but our whole ecosystem is based on trust from consumers, trust from the banks, trust from other players in the ecosystem, and it does not really work unless people feel like the other people in the ecosystem are taking compliance, data security, et cetera, as seriously as they are. And so when we look to the issuers or look at the acquirers to comply with the regs that apply to how they treat their customers, or make sure that they have the appropriate licensing and registration. That's all to make sure that they're doing the right things to manage their ecosystem, and that goes on down to making sure that they're keeping an eye on their FinTech partners and how they're kind of managing the direct to consumer relationship and other aspects of the program. Because again, like unless the different partners are kind of all focused on sort of the right things, then trust in the general system and trust from the consumers, which we're all ultimately there to serve, isn't going to be there.
Yeah, Gary, you want to chime in on that, given your experience? And I know we talked before that you've worked on vast programs and sort of dealing with risk management in that context. I'd love to hear about it.
Yeah. So, and first of all, I think thanks for the shout out, Key. I mean, that was always the focus, right? It's kind of like um, what is the trade-off between, safety and how do we approach it? And we have to understand how the market operates. And there were a lot of times when you could think about, we want a zero harm, no possibility marketplace, and you would just eliminate access for consumers as a result. Like that was the only way to get there. And that's not a good outcome either. And so you'd think about the different types of applications you could provide on there in terms of disclosure versus, penalties and things. In the BaaS space, the thing that I've always felt like, maybe as a recovering regulator, is that if you think about the underlying spirit of these things, what is there? There's to give consumers, and specifically in this case, consumer protection, things like transparency, control, to assume that they may want to change or, access different types of payment methods from different source accounts and everything else that comes through that. And building that into the product design strategically helps to ensure that we're not trying to attach something as an add-on at the end, where I will say before I became a regulator, I used to think legal and compliance was just a 2 month delay in any product rollout I was ever trying to do. And so I guess I drank some Kool-Aid. But in this BaaS space, we worked with a large platform provider that sat between several banks and dozens and dozens of downstream fintechs, with lots of different operating models. And it was pretty complex when you think about, the different models that they had, not only in like what the underlying product was, consumer, commercial, what the use case, but then what the division of responsibilities was between the bank, who happened to be the sponsor bank for each program, the platform provider, and the downstream fintech. And so we kind of went through an inventory of all of the regs and figured out which use cases they would apply to, and then built a playbook that was premised off of, where does the responsibility sit? What does that imply for this platform provider in terms of them having direct controls or oversight controls? What is the nature of that risk? And how severe is it? What's the volume that's going forth and so forth, to come up with I think a realistically fitted playbook attuned to what they were doing and whom they were doing it for. But make no doubt, and, that would come with dashboards and everything else. It's complicated. And I think that's part of the challenge in there as some of these providers start to serve lots of different business models. The the compliance oversight, the division of responsibilities, it can't be a one size fits all. The whom you're dealing with on the fintech side might, and what functions they perform versus you as a provider, whether you're a bank or platform provider, I think are going to dictate a different type of compliance program that touches all the same things but is executed differently. And I think being able to figure out that right mix is key.
Makes sense. And thanks so much. I mean, let me pause this here. We'll knock out a couple of questions, and then Aaron, get ready. I think I'm going to kick it over to you for the Regi P2P payments FAQs, and we'll do the discussion there. So I think first question was when I was talking about money transmitter licenses at the state level, can we discuss agent of the pay exemption? Of course. So the context there is that states have money transmitter laws like we talked about in a number of states, and they regulate the receipt of funds for transmission. So if you think about the classic money transmission, money's coming in over here, you're receiving it, taking custody and ownership of it with the intent or to actually transmit over to here. So a three-party transaction. The way that the agent of the payee exemption works is that roughly half the states, give or take, some are not informal, some of them are opinion letters, some of them are just statutory and you're out, some of them require certain things, but give or take, half the states have some form of agent of the payee exemption. And what that does is it says, hey, this is not trying to capture someone that's the agent of the payee, i.e. someone who has a contractual relationship with the recipient, the payee of the funds, where the person who gives the money to the intermediary, they have discharged their obligation, and the payee and the recipient have agreed, hey, that obligation is discharged the moment you give it to my agent. And so about half the states eliminate their money transmitter licensing regimes for those kinds of entities, and those don't apply. And so it makes it complicated because you got to monitor and track for those exemptions, and particularly if they're non-statutory, they can vanish at times, and so you want to sort of have a well-heeled reg change management program. But that premise is that there are certain things that are money transmission and certain things that aren't really the same as somebody that is out there offering for sale their business as come to us and we'll transmit money on your behalf. And instead are people that we're working for this company and we're there to process payments solely for them in that context via a tightly woven contractual agreement. And Key, I saw you come off mute, so I'll let you jump in if you want to there.
Yeah, I mean, obviously, the way you've described is it's exactly right, and I think it's half the states. Maybe I think they included in the new Model Money Transmission Act, and as more states sort of adopt that, hopefully it becomes more uniform. But obviously, if you're operating in 50 states, agent of a payee isn't going to like cover you everywhere where you operate. And then the other thing I would call out is that, and even within the states, certain states have certain expectations on how you affect that agent of a payee, and so the contractual language does actually matter in kind of a number of states. So it's unfortunately it's not as simple as just saying, well, we're operating as agent of a payee, and therefore, we don't necessarily need to get money transmission licenses. There is an art to it, and you need to appreciate also that it might not cover you in all states.
Yeah, and that Modernization Act is continuing to spread, but it's like uniform laws. They're only uniform until they start to get actually adopted by legislatures, and then they have a tendency to fracture and have little specific provisions across different states. The second one was, and I'll hit this briefly because Aaron touched on this partially at the beginning, was what are some of the considerations to take into account whether a non-bank fintech should leverage a depository institution and have them do the money movement for them versus going out and getting your own licenses. I mean, there's a lot of things that go into that. I mean, I'll share an anecdote. I remember one time as a favor to a friend, I chatted with a CEO where they said, this is how much money is going through the bank. This is how much money we could earn, this is how much float we have, et cetera. Should we go out and get money transmitter licenses? And I was like, well, what's the interest you would earn on your account you set up if you're a money transmitter, given current market rates? And they're like, $100,000. And I was like, well, we should just end this call. Like, you're going to spend fantastically more than that just getting your licenses, not even reviewing the state laws, going through and dealing with the regulatory exams and all of that. And it was sort of a proxy for it's a real big endeavor. These aren't ministerial permits. These are substantive laws, highly restrictive in terms of what you're going to do. And you have, 49, 50 different regulators. And while there's a lot of uniformity in money transmission as compared to other laws where there are a lot more disparate provisions across the states, it's a significant ordeal and there are significant requirements. Utah, I think their regulatory regime has like a mandatory minimum $1 million net worth provision that just structurally kicks out fintech sometimes because they don't have that level of financial capitalization and context of being an early stage company. And so you have certain things that go into that. And I think you got to look seriously and with eyes wide open about the regulatory apparatus that you have to have. And sometimes you can do that and your scale and heft makes sense a million times over. And other times it makes sense to leverage parties that have that infrastructure built out. They already can do a lot of those things. And then you can grow in partnership. And then, we've seen companies do that and then essentially convert over to becoming the licensed entity themselves once they get a handle on it and they get scale. Others stick with that. So Aaron and I could probably do an hour-long panel on just that. So I'll leave it there. But it's an interesting set of considerations about, are you really ready to do it? And of course, there's a lengthy timeline process that you're not waiting for your banking partner to go get a charter, like you might be waiting for California and New York to issue you a license and the time periods there. So with that, Aaron, let me kick it over to you. Would you mind running through as the first of sort of recent issues, running through the Reg E FAQs and maybe we can talk about that a little bit?
Yeah, I know we want to leave so a couple of other questions have come in. We want to leave time for questions, so I'm not going to go too deep into these. They're not overly new anymore. But probably one of the in the bank partner context at least, and sort of non-depository, as we've seen the way in which we're transacting, right? I had dinner with one of our older partners a year ago, and I fundamentally do not carry a wallet and only have my phone. And if the restaurant does not take Apple Pay, then I'm washing dishes, or I'm gonna have the partner that actually does carry a wallet pay for it, one or the other. But like, I don't carry a wallet. Everything is happening with my phone. I know Robert and I did a presentation maybe a year or so ago where we asked, and I am the majority when it comes to some of that, as far as the way that looks. And so, how does that work, right? I use Apple Pay to access my bank account with a depository, and something goes wrong with it, right? It's in some ways you can initiate that transaction a lot easier. I could leave my face, I could use Face ID, have it open, and somebody comes up behind because I left it on the table, or a million different ways that things could kind of go wrong there. And what does that look like? And that they put out an FAQ on Reg E. It's kind of the first time that I'm aware of it. They've really touched Reg E in a very, very long time. FAQ is back in June of 2021. Um, I don't know if Gary was a part of that at that time.
No.
Okay, good. I won't go light then. Um, it was an interesting FAQ in the sense that it redefined some terms and saying that it didn't, and they were just clarifying through frequently asked questions, but I think really redefined some terms, but made it clear that there are instances where the non-depository is a financial institution for purposes of Reg E. They issue an access device. They provide electronic fund transfer services to the consumer, and that they could have their own direct liability as it relates to Reg E, not just the what I think most people thought of as that was the account holding entity's
Mhm.
responsibility. And really, the FAQ kind of talked about how there are instances where that's not the case, and there are instances where there could be direct liability on the P2P provider, the person-to-person provider, the non-bank wallet, the non-bank way in which you're making payments that would hold some error resolution liability, which probably makes sense. Probably should have gone through rulemaking, but it probably
Mhm.
makes some sense that um, the consumer doesn't really always understand who they're transacting with at that point, and who they contact because something went wrong. Then the FAQ kind of doubled down on this idea that's been true forever. It was in the original commentary to Reg E. You cannot take a consumer's negligence into account when it comes to error resolution. So the old school version of that was, I write my PIN on the back of my card. Somebody steals my card, uses the PIN that I wrote on the back to take cash out. When I'm investigating that error, I can't hold it against consumer that they wrote their PIN on the back of the card. They didn't authorize the withdrawal of the funds. This talked about that in sort of the modern era to some extent, and talked about the difference. Gary, I'm not sure if it was you or Chris that touched on this earlier, but um, they differentiated between fraudster tricks me into doing a transaction.
Mhm.
So it's not unauthorized. I authorize it. I just got tricked into doing it. Not unauthorized transaction under Reg E typically. Or fraudster tricks me into giving them my payment credentials. They initiate a transaction. That is going to be fraudulent, right? So they kind of talked about this difference between a fraudster tricking you into making a payment versus a fraudster tricking you into giving payment credentials to them, and that one would fall within an unauthorized transaction and one would not. So there's a lot more to it. We just don't really have a lot of time, but for the most part, it was really trying to fit non-depositories into the definition of a financial institution in some instances. Explain the concepts that we talked about a little bit earlier with Chris, as far as error resolution responsibility. Somebody's got to do it, so talk to each other, right? It's really important to have a good compliance management system there. And I don't say that because I built compliance management systems for 12 years and it's a pet peeve of mine, but just because it's true. Um, you have to be kind of careful when it comes to how that's going to work. But outside of that, I can answer questions on it, but I
Yeah,
just
well,
I don't want to spend
if
too
I
much.
could chime in
Yeah,
on that,
yeah.
Aaron, because so yeah, just to be clear, I left at the end of 2020, so unless I was not there for the last administration, and it's kind of like somebody moves into the house you lived in for so long, and you're gonna look back and say they put what furniture in there, and it's hard not to have that feeling. I would just say that one of the frustrations maybe with this past administration is that there were some, like, and you touched on this, Aaron, there were elements of like, we should be considering this, but then, maybe the jump to a conclusion or the method by which they introduced this to the market, not through full notice and comment would be questionable. And, if you think about some of the things that we wrestle with, ultimately, regulation is not really counter to what a financial service provider, the spirit wants to provide, right? You wouldn't want to put out a payment system that is error prone, where consumers can't feel confident that they are using it and are going to have a good experience and send people to the right place. So you'd never get anybody to adopt it. You also can't build a payment system and de-risk onto the consumer. You might be able to de-risk onto corporate treasurers, and finance of large, sophisticated companies, but not onto consumers. And so there are elements there, like the thing I would always use in the negligence case, which would frustrate people, is like, what if pins were 50 characters? Nobody would ever remember them, right? So you wouldn't fault somebody for writing it down. Is four too many? I don't know if I've got 15 cards in my wallet. Like, I don't know what that line is, and I'm not going to try to paint it here, but there is some point at which you could start to see the other side. Same thing as, obviously one of the things this administration did was to take step back on a enforcement action against Zelle and some of the large banks. And, ultimately, if you were to put out a payment system that was too easy to butt dial payments to somebody, fat finger where it's going to not have confirmation of payee and all of those things, or to put out a payment system where the providers, the nodes on that network weren't held accountable for ensuring that bad actors were not let into the payment system because they weren't monitoring them, weren't going through KYC and other things, right? You could see a situation where consumers, like, are dodging minefields to use it. To your point, it's kind of a new world, and how you define that versus shoehorn it into existing regulations, I think, is debatable, but that underlying spirit is there. And so, like, Visa and anybody else that's on this call, like, nobody's here because they want to gouge consumers. It's thinking about those things. And I think that's kind of the lens we gained as a regulator. Drawing the lines is the hard part. And inevitably, when any administration comes out with it, it's going to create people that like it and people don't like where the line is drawn. But at least if we start with what is the concern here, and if that's built into the design of these solutions, that goes a long way to start.
Yeah, no, it's if this were a full Reg E dispute, you would all have to hear my oft repeated story of in-purchase apps and my daughter's
Yeah.
$1,000 worth of Pokemon Go purchases.
Oh, who hasn't had a household?
Broken screen, okay, and she just kept hitting it over and
Yeah.
over again. 299 about 700 times.
Yeah. My oldest son did that. And he's 26 now. That probably happened about 15 years ago. So it just shows you that some of these things haven't been fixed.
Exactly. Although the system worked for me, I will say that. But
Yeah, for me as well.
Far cry from my little brother going to Burger King 3 times in a day to my dad's chagrin and getting 3 different NSF charges. because of course, on his account for about $135 a Whopper from Burger King. But
Can I get the Whopper yet? Can I get
that's
it?
right. That's great. 3 times, same place in Burger King? Really? Okay. All right, we have one more, and I know we kind of went through a number of things, and so I think the last discrete topic, I don't know if y'all want to try to slip it in, and then maybe we'll handle that last question. Key and Aaron, I don't know if y'all want to talk about, the recent developments in surcharge and transparent pricing issues and sort of where that's going, or if that's something where it's going to take us too long to unpack, we could kind of skip to questions. You tell me.
I can talk about it in 2 seconds, and then Key might have better things to say.
No, I
But
was just saying we don't have enough time. I don't
No,
think.
no, you're on the spot now. Go, Aaron.
I'll say it real fast. Credit card surcharges is what Robert's talking about. There used to be a bunch of states that prohibited it. Supreme Court said no go. Most states took it off their books. A couple still have them on their books, but I don't know how well they're actually able to enforce them. Um, the idea is, can a merchant add a surcharge if you're using a credit card? Cannot do it on a debit card. I cannot tell you the number of stores I walk into where they try to do the surcharge on a debit card. And I'm like, dude, you can't. I know because I do this for a living. But anyway, what we've seen, and Robert Key's right. We don't have time to really get into this, but just to kind of tease it up in case we want to do something further down the line, there's been some like transparent UDAP type statutes, transparent pricing statutes some states have passed that are not specifically about credit surcharging. They do not prohibit credit card surcharging, but they require you to include the total price of the transaction as part of the advertising, as part of the shelf price. And so arguably that could include some things that would get a little bit complicated. So I don't know if that's going to become a trend. We've seen it in a few states where you've got this UDAPI overlay. But from a technical perspective, credit card surcharges, when allowed by Visa, MasterCard, right? There are rules if it's a branded card as to how you can surcharge, but they are legal. Just be careful of maybe some, potential landmines in state law as they're trying to sort of think about it again, having sort of lost their battles a few years back on trying to limit or prohibit surcharges at the state level.
All right. Well, Chris, I won't ask you to talk about managing those in context of multiple programs like I plan to, since even Aaron concedes he doesn't have enough time to kind of go through it. So we'll do the one question and then we'll kind of wrap. I mean, the last question, I'll kind of read through, ask for y'all to chime in if you want to, and if you don't, I'll make Aaron and I go through it. The question was, as we discussed how to navigate payment compliance and the shifting landscape, and with the recent shifts at the federal level, what major actions or flagship actions do we anticipate on the part of states to protect consumers, and what should we be thinking about considering as we think about those changes and impact on product design and innovation? So I'll open it up for questions, and if you don't want to chime in, that's what outside counsel are for anyway, right?
I unmuted fast, so
You did. You're eager. You're eager. Although before Aaron says anything, we're not your lawyer. We're just presenting and giving our own opinions. All right, go ahead, Aaron.
No, I mean, I think one of the things that I think everybody in this call for the most part has touched on it. One thing to remember is that federal law is not gone. Determinations to not enforce are very different than getting rid of underlying law or changing some things around, right? And so I liken it a little bit to cannabis banking, speeding 5 miles an hour, 5 miles over, probably not gonna get a ticket because they're not gonna enforce it. But if they want to, they can give me a ticket for it. And I know that for a fact because I lost my license at 19 for going 4 over. So they can do it. Right. Enforcement is different than changing law that decide to lack. So A, don't ignore what's out there. B, understand all of the network rules, right? The card network rules and NACHA rules that are not really overly impacted by the shifts in the regulatory landscape. Really? I mean, a little bit because they're going to take into consideration, but not quite as directly. And then it's just some of the stuff Robert talked about earlier, right? Going down to a pro con list of where partnering with a financial institution that has certain rights under federal law makes sense to navigate some of that, and keep your eyes open for the states, right? I mean, everybody is right. The states are going to ramp up. We've seen them ramp up, and you just got to kind of keep your eye on what they're doing to be there. But really, in the payment space, you're so much into network rules and ACH rules and card rules that I think my opinion is it's a little less than in some other areas. But
Yeah.
that's just
I,
my opinion because you're in those network rules so much in this space, and not Reg E is outside of error resolution. Reg E has been Reg E for a very long time.
The only other thing I'll add is that the Bureau did do the post-election pre-inauguration roadmap for state lawsuits. That's just my personal view of what happened, but they did do a lot of policy statements, other things there. They said, here's issues, here's UDAP claims and all that. So when we think about where the states are likely to do it, it's dismissed lawsuits by the CFPB, where states like New York or California are going to pick up the same claim and bring it under secondary authority under a UDAP principle. And then you can look at policy initiatives, amicus briefs, other things that were done by the Bureau in that post-election pre-inauguration period where their activity level ramped up so dramatically. That's your roadmap to where the flagship state action is going to be because they're the easiest ones. They plowed the field, they laid out analysis. So with that, I'll just say thanks so much to the panel and everybody else for joining, and we appreciate your time and hope everybody has a great week.